Welcome to my channel. I'm going to show you step by step how to value a stock. Together we will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end we calculate and analyze the financial ratios. The company we're going to look at is Nautilus. And this company is a marketer, developer, and manufacturer of fitness equipment brands including Bowflex, Modern Movement, Nautilus, Octane Fitness, Schwinn Fitness, and Universal. This is a really exciting stock because during coronavirus, people can't really go to a gym anymore, so they've been ordering equipment like this. So the stock has been up over 600% this year already. Let's get started with the model. This company has a market cap of $423.1 million. And they're trading at $14.12. Around April, it was trading at like $2.25. So it's been up a lot. Let's get the free cash flows. That's how you value a company. You estimate the future free cash flows and then you discount that number back to today's value. And the free cash flow is cash flow from operations minus capital expenditures. We also need the net income, which is a profit and loss on the income statement. And I'm going to pull 4 years of that and put it into the model. And also the revenue, which are the sales for each year. You want to take a quick look at the numbers. They had a bad 2019, negative free cash flow and negative net income, and their sales were down. Hopefully in 2020, with coronavirus, sales will be up. Let's look at a capital structure. The interest they pay on their debt is $980,000. Let's see how much debt they have. We'll go to the balance sheet, go to liability section. No current debt. Long-term debt of $14 million. That's debt due after 12 months. And let's get their effective tax rate, because interest payments on debt is tax deductible. Income before tax is $21 million. Income tax is $5.9 million. So to get the cost of debt, that's the interest rate they pay on the debt, 7%, times 1 minus the effective tax rate, and that comes out to 5%. To get the cost of equity, we need the beta. That's how volatile the stock is, and it's 1.5. We need the current assets to calculate the current ratio later. That's $129 million. Let's see what that is. That's $11 million of cash, $54 million of receivables, and $55 million of inventory. We also need current liabilities to calculate the current ratio. That's $88 million. Let's see what that's made up of. $74 million of accounts payable and $10.7 million of accrued liabilities. Accrued liabilities are expenses a company incurs, but it hasn't paid it yet. Let's get their equity. That's total assets minus total liabilities. That's about $91 million. Let's see what that is. $1.3 million of common stock, $90 million of retained earnings. That's previous net incomes minus previous dividends. So they're operating profitably in the past. And negative $937,000 of accumulated other comprehensive income. Let's go back to the income statement, get their operating income. That's negative $28 million. Let's look at the capital structure. Cost of debt is 5%, weight of debt is 28%. Cost of equity is 87%, weight of equity is 14%. And the WACC is about 12.5%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We're going to value the company $520 million. We divide that by 30 million shares. We get an intrinsic stock price of $17. It's trading at $14, so it's trading at a 19% discount. So this is a buy according to the model. Simply Wall Street has them way higher at $48 because I think analysts are expecting this company to really grow during COVID. Let's see where the stock has been trading at. So it was a lot higher a few years back, but it really dropped in 2019, 2020. But it's been a huge upswing since coronavirus, and I think it's going to go higher. Let's look at a capital structure. They have a negative PE, good price to sales, and a weak price to book. Negative PE, because that's stock price over earnings per share. To calculate earnings per share, that's net income over equity. They have negative net income. Let's look at a price to sales ratio. That's stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 1.4. This indicates investors are willing to pay $1.40 for $1 of sales. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 4.7, so this indicates investors are willing to pay $4.70 for $1 of book value. They have a good current ratio, a negative interest coverage ratio, and negative ROE. Current ratio is current assets over current liabilities, so they can cover their current liabilities. Negative ROE, since they have negative net income, and negative interest coverage ratio, since they have negative EBIT. The best way to look at ratios is to compare them to similar companies. I've done videos on Planet Fitness and Six Flags. They're in the same industry as Nautilus. Their price sales is better than the average. They have the best price to book. They're actually the only company with a positive price to book. The other companies have a negative book. That means they have negative equity. Their current ratio is above 1, so that's fine. Negative ROE. They're the only company without 100% debt. So maybe during coronavirus, this company's going to really thrive. And they're really small compared to their competitors. So let me know what you think of the video. Thanks for watching.